Hello, Dr. Byram. I hope you are doing well. Tram, Aimee Murillo, Jessina Sparenberg, and I, George El-Tayssoun, will be presenting the capital structure, financial statements, analysis of financial statements, and our results and comparisons from the years 2016 and 2017 for the companies we have chosen, T-Mobile and Verizon. These two companies provide cellular data plans and devices to their customers worldwide. Their main competition, besides each other, are companies such as, but not limited to, Sprint, AT&T, Cricket Wireless, Metro PCS, Virgin Mobile, etc. The cellular industry is very proactive in comparison to other industries and requires the companies within it to be very competitive with each other when it comes to having the newest devices and providing the best services for the best prices to their customers. It seems like only yesterday we were using flip phones on 2G networks, and now we have sophisticated touchscreen phones with more computing power than some computers, running 5G network speeds that can be used almost anywhere in the world through just one single service provider. Without further ado, let us take a look at these communication revelations from a financial standpoint.
In this slide, we have capital structure of T-Mobile and Verizon. As shown in the chart above, Verizon's overall capital structure is much greater than T-Mobile's. From 2016 to 2017, in Verizon's company, we can see a clear decrease in total debt to total equity and total capital, as well as long-term debt to equity and to total capital. However, Verizon had a total debt to total assets increase in those 2 years that went from 172.4 to 177.37. As for T-Mobile, within 2016 and 2017, all of the capital structure decreased significantly. Overall, both companies reflect a lower level of debt from year 2016 to 2017, which is a pretty good indicator for these two companies. Now we have market capital for T-Mobile. In 2016, there was a market cap of $47.39 billion and total assets of $65.89 billion. And dividing those two numbers, you get 72%, which was a portion of the company owned by the market. As for 2017, the market cap was $52.84 billion, total assets $70.56 billion. And the portion of the company owned by the market was 75%. So there was a 3% increase within that 1 year, and the stock exchange was NYSE. As for the market capital of Verizon, we had in 2016 217.61 billion from the market cap and total assets of 244.18 billion. Dividing those two numbers, you get an 89% of the portion of the company that was owned by the market. And in 2017, there was 215.92 billion the market cap, 257.14 billion as total assets, and an 84% of the portion of the company was owned by the market. Unlike T-Mobile, Verizon actually had a decrease in this of 5%. Comparing these two companies, there was a larger number in Verizon, and the stock exchange for this company was also NYSE. Regarding equity and debt for T-Mobile and Verizon, there is an increase for both of the companies' equity and also for their debt. However, T-Mobile had a slight change in numbers in equity, going from 18,236 to 22,559 from 2016 to 2017. As for debt, it barely increased, going from 2016 30,407,000 to 30,909,000. In Verizon, the equity almost doubled, going from 22,032 to 44,687. And for debt, it increased slightly, but much more than T-Mobile, which went from 108,078,000 to 117,095,000.
For net working capital, T-Mobile shows a calculated difference of almost $2.6 million. The net working capital is calculated by subtracting current liabilities from current assets. T-Mobile had a great number of current assets than current liabilities in 2016, but soon the current assets became less than the current liabilities by 2017. The net working capital calculated for Verizon between year 2016 and 2017 have not drastically changed. The current assets for Verizon totaled less than their current liabilities for both years. A balance sheet states a firm's financial position at a specific point in time. Net working capital is the difference between current assets and current liabilities. The total debt for Verizon increased by almost $10 million from 2016 to 2017, while T-Mobile's total debt only increased by a few $100,000. Income statements summarize the firm's revenues, expenses, and profits during the reporting period and is available for common shareholders to view. T-Mobile has dividends per share of $0.00 for both 2016 and 2017. This can mean that the company irregularly pays out its dividends instead of quarterly payouts like Verizon. Due to the irregularity, there is no guarantee that the stock will pay a dividend in the next year. Free cash flow is the amount of cash that can be withdrawn without harming a firm's ability to operate and to produce future cash flows. Verizon has a higher net income than T-Mobile, possibly because Verizon is more popular and brings in a lot of customers. With the net income of each company, it shows investors the condition the company is in with their cash operations. The difference of the free cash flow amounts from years 2016 and 2017 for Verizon was $2,307,000, and for T-Mobile, $1,292,000. Both companies have positive cash flows, meaning that they both have more than enough cash to finance current investments in fixed assets and working capital.
Continuing on to the ratio analysis of the two companies. I've put together a chart that consists of the ratio analysis of T-Mobile, Verizon, as well as their industry average for the year 2017, shown in red, and 2016, shown in blue. I then rate each company ratio from either good, average, or poor, compared to the industry average. Additionally, I also compared the two companies with each other and highlighted in green the ratio that is more qualified out of the two. First, let's look at the company's liquidity ratio. Compared to T-Mobile's declining numbers, Verizon is doing a better job at paying off its short-term liabilities from 2016 to 2017. More noticeably, Verizon's quick ratio of 0.77 compared to T-Mobile's 0.27 in year 2017 shows that the company is able to quickly meet its short-term obligation without the need of its inventory. However, compared to the industry average, the two are doing poorly. A way the companies can increase their liquidity ratio is by raising its current asset and/or reducing its current liabilities. Moving on to the company's asset management ratios. We can see that Verizon does a lot better on its inventory turnover for both years and is also doing well above the industry average. However, T-Mobile is better adapt with days sales outstanding, fixed asset turnover, and total assets turnover ratio. Its numbers are also well above the industry average for both years. In conclusion, with the exception of the low inventory turnover ratio, which can be fixed by increasing its sales or decreasing its inventory, compared to Verizon, T-Mobile is more efficient at using its asset to increase profit. Continuing on with debt management, T-Mobile's total debt to total capital ratio shows that its ratio has increased from 2016 to 2017. On the other hand, Verizon's ratio has decreased from the past year. This indicates that Verizon uses less debt to cover its assets, comparing both industries that has been ranging around the 40s for the past year to the industry's average around the 20s, and this shows that both are doing poorly. However, even though both companies uses more debt to cover its assets, their time interest earned ratio indicates that they are able to honor their debt's payment, since their ratio is above industry average. Overall, even if the company's total debt to total capital is rated poorly compared to the industry average, this might not necessarily be considered a bad thing, because by incurring debt, the companies take advantage of tax reduction. As long as they are able to pay back their debt in a timely manner, they got nothing to worry about. They just need to be careful of incurring too much debt, as it would prevent them from getting a loan in case they need one. Looking at the profitability ratio, T-Mobile and Verizon has both increased its profitability ratio from the past year. Both companies is doing really good above the industry average, with Verizon being the better of the two. This is good as it shows that the two companies have no problem generating profit compared to its expenses and other relevant costs during the past year. Looking at the last ratio, which is the market value, we can see that T-Mobile and Verizon's price per earnings and market to book ratio has been declining for the past year. Compared to each other, T-Mobile has a higher price per earning of the two, and while compared to 2016 when it was under the industry average of 69.47, T-Mobile was able to become above average when industry average dropped to 28.63. For market to book ratio, both companies are above industry average, where T-Mobile shows an increase in the past year while Verizon showed a decrease in ratio. Regardless, Verizon is still the better of the two with a ratio of 9.66 in 2016 and 5.01 in 2017, compared to T-Mobile's ratio range that is under 3 for both years.
And now, finally, I present to you the winner of our financial standoff between T-Mobile and Verizon. Verizon. The data from Verizon and T-Mobile's capital structure and financial statements, as explained by my colleagues, highlight key aspects of the 2016 and 2017 fiscal years that prove Verizon's victory. Some highlights of our research include Verizon earning a net income that is more than 7 times that of T-Mobile's in the year 2017. Another key factor is T-Mobile and Verizon's high operating margin ratio, which shows how efficient the companies are at managing their costs by being able to generate sales at a faster rate than the industry average. On the other hand, investors will also benefit from investing in Verizon's shares, as they can expect to receive a return of $2.34 per share in comparison to T-Mobile's $0 return in the year 2017. To be fair, both companies have shown quite an improvement in their financial standings from 2016 to 2017, and with the impact of upcoming technological advances in the market in smartphones and network capabilities in the year 2018, the numbers seem like they will only get better. Examples of such advances are, but not limited to, Apple's new iPhone X Plus, and Samsung's new Galaxy Note 9, which are both rumored to debut sometime this coming summer, and a more recent and very controversial merger between T-Mobile and Sprint. Sources such as the New York Times have published articles stating that this merger will be good for the companies but not very good for their customers, because with the merger, T-Mobile and Sprint's competitiveness will lessen, since they now have more control over the prices of their services. This is forecasted to take a toll on the economy as a whole. Now, in what the Times are calling a wireless war, there are only 3 competitors left in the market: T-Mobile, Verizon, and AT&T, because T-Mobile and Sprint decided to take the name T-Mobile for their new merged company. The Times also names this the curse of a triopoly. But as we have discussed on many occasions, we only know the past and present for sure. The future can be predicted, but there is always a chance of a different outcome, depending on the unpredictable variables. In other words, only time will tell. Thank you very much for taking the time to view our presentation, T-Mobile versus Verizon. The end.